Hi all, welcome to this session. In this today's session, we are going to discuss about dividends, dividend policy and stock split. Before going to dividend policy, we have to understand that what is dividend. What is dividend? Dividend is a distribution of company's profit to its shareholders. Shareholders invested in the company. So as a reward to shareholders, dividend mean is the distribution of its profit to shareholders. It represents a return on owner's equity. That means the owners or the shareholders are invested in the company for a return. So the dividend is one of the return that shareholders are expecting from their investment. So again, the dividends will be approved by the board and other respective authorities. In simple terms, when company make a profit, it can either reinvest or can distribute. Suppose if a company make a profit, this profit can be distributed to its shareholders or to hold owners, or it can reinvest in the business. That distribution process is called dividend. If the company make a profit, there are two options are there. First thing, it is reinvestment in the business or the distribution of that profit to shareholders. So that distribution of that profit to shareholders that we called as dividend. Why do companies pay dividend? Company pay dividend to reward shareholders. The first thing is to reward the shareholders. That means shareholders are invested in the business to expecting a reward or a return. The dividend is one form of a reward that company giving to its shareholders. So the first reason that the company is giving dividend to its shareholders is to reward its shareholders. Dividend provide regular income to investors. Again, the dividend is also considered as a financial strength and stability. If a company is regularly paying the dividend to its shareholders, that is considered as its financial strength and the stability. So if you pay dividend regularly, normally, definitely the investors will prefer to invest in your company. So that's also one of the reasons the companies are paying dividend to its shareholders. Then let's move into type of dividends. Type of dividend. First one is cash dividend. Cash dividend is straightforward. It's a paying dividend as cash. It reduces companies' cash and retained earnings. This is one of the most common type of dividend, that is cash dividend. It is transferring money to shareholders' bank account based on their number of shares. That means companies declaring a particular dividend per share based on the number of share owning by each shareholders, they will get that particular dividend. Suppose the company is declared a $2 dividend for an investment for a per share. If a shareholder holding 100 dividend, who will get total 200 as dividend. So this is very straightforward. Then the stock dividend. Instead of giving the cash, sometimes the companies will give the additional shares as dividends. Additional shares mean the fund they are taking, companies taking from the retained earnings and that using for the other business purpose or the development purpose, and that issuing as a new shares to the existing shareholders based on their current share structure. In the stock dividend case, the ownership remains same because the share proportion not changing. Each shareholders will get new shares based on their current proportion of ownership. So the stock dividend not changing the existing ownership pattern. Then the property dividend. Property dividend means it is paying dividend with any non-cash asset distributed to shareholders. It is not a common practice. So property dividend, just to understand, it is a paying dividend in property or non-cash asset as non-cash assets. Then the scrip dividend. Scrip dividend mean, suppose the company want to pay dividend now or to declare the dividend, but company doesn't have enough money to release the dividend now. In this case, the company can issue the scrip dividend. Scrip dividend mean is a promise to pay dividend later. Scrip dividend mean is a promise to pay the dividend later. Again, it's create the liability until the payment. When the company have a temporary cash shortage, in this case, company will use the scrip dividend. Maybe in the next cycle, company will get enough money. That time, company will release the dividend. So this type of dividend called as scrip dividend. Then the liquidating dividend. Liquidating dividend means paying dividend from the capital than the profit. It is reduce the paid in capital. Again, if a company want to return some of its investment or liquidate some of its investment, so in this case, the company can pay the liquidate dividend. Liquidate pay means it is taking a portion of capital and paying as dividend instead of profit. Normally, dividend are paying from the profit, but in the liquidating dividend is taking from the capital rather than profit. Then the preferred dividend. Preferred dividend means a dividend paying to preferred shareholders. What is the feature or characteristics of preferred shareholders? They will get the preference over the payment of dividend and repayment of initial investment. So the preferred dividend definitely must be paid before the common dividend and may be cumulative and non-cumulative based on the type of preferred stock. Then, until now we discussed about the types of dividend. Now let's move into dividend policy. Dividend policy is a policy where the company is determining how much proportion of profit to be paid as dividend and how much to be retained in the business. So if the company made a profit, company have two options. It can distribute to shareholders and it can retain some of its profit in the business. So the dividend policy is the policy which determine how much profit company should be retained in the business and how much profit should be distributed as dividend. There are a lot of factors affecting the dividend policies, like the company's future expansion plans. If the company have a future growth plan or expansion plan, definitely the dividend may not be paid, or there will be a small portion of profit will pay as dividend and balance amount or retained earnings will reinvestment in the business. So again, it's affected by various factors, again by company to company, by industry to industry. There are a lot of factors has to be considered while deciding the dividend policy. So it's a policy which determines how much profit is to be paid as dividend to the common shareholders or to shareholders. The first category of dividend policy is stable dividend policy. Stable dividend policy is companies pay consistently or gradually increasing dividend. That is a stable dividend policy. That means that profit, that dividend is predictable to investors. That means that company is paying consistent dividend by period to period. This dividend policy is called a stable dividend policy. It is very common in the matured companies. That means if a company is very matured, normally they will follow the stable dividend policy. That means they will pay a fixed constant amount by period to period as dividend. Then the residual dividend policy. Residual dividend policy means in the residual dividend policy, here the first priority is for the reinvestment or the expansion. If a company have a growth plan, a huge expansion plan, that type of companies will follow the residual dividend policy. Residual dividend policy means dividends are paid only after funding the investment need. If company has some investment need, the first priority will go to fund that investment need and pay the dividend. And dividend payout is depend upon the availability of leftover earning. If the company reinvested, considered all the investment requirement and still the retained earnings or the share of profit exists, then only they will pay the dividend. In this type of residual dividend policy, dividend may fluctuate time to time. It is not a stable dividend. That means dividend will fluctuate from time to time based on the investment requirement time to time. Then the hybrid policy. Hybrid is the combination of both stable and residual policies. Pay a base dividend plus extra when profits are high. That means in the hybrid policy, there will be a minimum level of dividend in all the cases, and the extra profit or extra dividend will pay based on the profit company made. If profit is higher, that extra dividend will pay higher. If the profit is lower, that extra dividend may not be paid. So this hybrid policy balances stability and flexibility both. There will be a small stable dividend plus a flexible dividend based on the company's earning. That is hybrid policy. Then the zero dividend policy. In zero dividend policy, the primary priorities or only the priority is to reinvestment in the other business needs, not to pay the dividend. In the zero dividend policy, the company retain all earnings for the growth. No cash dividends are paid. It is very common in the high growth firms. If a firm is in a high growth stage, definitely the management may prefer the zero dividend policy. That means all the earnings the company made will reinvestment in the business. So these are the 4 dividend policies. The first thing is stable dividend policy, then residual dividend policy, hybrid policy, and zero dividend policy. Then dividend signaling effect. That means what a dividend, if a company paid a declared a dividend, what it is signaling into the share market or into the market. Definitely if a increased dividend or a stable dividend is a signal strong future earning and financial stability, a dividend cut may signal financial weakness. So definitely the market will react based on the company's dividend policy. If a company is normally paying regular dividend and increased dividend or increase in dividend, definitely this will indicate the strong financial status of the company. If the company cut off its dividend, it may signal to weak financial status or weak liquidity status. So based on the dividend policy, the stock market will react to stock prices. The dividend decision provide information to investors. Based on the dividend information provides some investment information or investment advice to investors. So based on that, the investor will choose the investment also. Now, dividend policy have impact within the company also in the outside of the company also. That is the external things also affected. That means the investor perspective, the market value, all these things will be affected with the dividend policy. So let's move into dividend payment process. Dividend payment process, the first thing is the declaration date. Declaration date is the announcement date of the dividend. In the declaration date, the company record the liability. Once the dividend is declared, it record a liability as dividend payable in its books of account. Then the ex-dividend date. Ex-dividend date is a particular date which is decided by the management. That means share purchased on or after of this date will not receive the dividend. So until this date is anybody purchased the share, they will get the dividend. After the ex-dividend date, if somebody purchased or an investor purchased the dividend, they will not receive the investor purchased a share, they will not receive the dividend. Then the record date. The company identifies eligible shareholders for the dividend. So this is called record date. Then the payment date. Payment date is the date where cash is distributed to shareholders and the liability is settled. On the payment date only, the cash is distributed to the shareholders and the liability is also reduced. That means the dividend payable liability is settled on the payment date. Then let's move into stock dividend versus stock split. Stock dividend mean we discussed now issuing dividend as in the form of stock or issuing additional stock based on the ownership rate. So in the stock split, the retained earnings is transferred to shareholders' capital, and that amount equal to that amount they will issue the stock dividend. In the stock dividend, the total remain retained unchanged because even in the share capital and the retained earnings both will remain as both will come under the equity section. So in the stock dividend, the total equity remain unchanged even after the stock dividend. Then the stock split. Stock split mean one share or each share divided into more shares, into two or more shares. That means if one shareholder is holding, if the stock split of 1 into 2 mean if a shareholder is owning one share, then they will get two shares instead of that one share. Again, the market price of that share decreased proportionally, and at the same time there is no changes in the total equity, because in this case the total number of share will increase, but in the total equity will remain unchanged in the stock split. So the key difference is in the stock dividend the accounting entries are required, but in the stock split mostly cosmetic adjustment only required. Both stock dividend and stock split will not change the ownership percentage of existing shareholders. Then the reverse of stock split. Reverse of stock split means it is a reduced number of shares outstanding. That it will increase the price per share. Suppose if a company has total 500,000 or 1.5 million number of shares, it reducing its total share to 750,000 or into half. That we called as reverse stock split. It is just a reverse of stock split. That means in the stock split it is increasing the number of shares, but in the reverse stock split it is decreasing the outstanding number of shares. The dividend reinvestment plans. Dividend reinvestment plan is an automatic system which allow the existing shareholders to reinvest their dividend automatically. So the dividend, instead of paying the dividend, it used to buy the additional shares. So it encourages the long-term compounding for the investor. So this is a method or is a system that allows shareholders to reinvest the dividend automatically in the share. Then the treasury stock. Treasury stock refers to share repurchased by the company. That means if a company have excess money, that company can purchase its existing shareholders from the stock market. That we called as treasury stock. So in the treasury stock, these shares have no voting right or dividend. If a company purchases its own share, so this share does not have the voting right and the dividend. It reduces the total shareholders' equity. So the effect of treasury stock, first thing, it is reduced number of shares outstanding because it is purchasing the outstanding shares from the market. It may increase the earning per share. That means it is reducing the total number of share, which will reduce the EPS, earning per share. Sorry, it will increase the earning per share. What is the formula for earning per share? Total earning divided by number of shares. So if in the case of treasury stock, the number of shares is getting decreased, so it will increase the earning per share. Then it is reduce the total equity in the balance sheet. The existing profit or retained earnings may use to purchase the treasury stock. So it will reduce the total equity in the balance sheet. So this is the difference between dividends versus share repurchase. Dividend returns cash directly to shareholders. Share repurchase reduces the shares outstanding. Both methods are distributing the values. The dividend method are distributing cash to shareholders, and the share repurchase is the purchasing of the existing share number of shares from the market. So here is the summary of what we discussed. The first thing is what we discussed is the cash dividend. The main effect is cash payout and reduce the retained earnings. If the company paid cash dividend, it is definitely reducing the retained earnings. Then the stock dividend. Stock dividend means it is more shares are issued instead of paying cash dividend. Then it is reclassify the equity. That means if there is a retained earnings may transfer to owner's capital. Then the stock split. Stock split is shares are divided. The existing number of shares are divided into a different number and no equity changes in the stock split. Then the treasury stock. Treasury stock means share repurchased. It will reduce the total equity shares. So these are the three concepts what we what we discussed now. The cash dividend, that means paying out the dividend as cash. Then the stock dividend, paying the dividend as stock. Then the stock split, it is splitting existing number of shares into a double or more than or a triple. That means one shares is distributed or splitted into 2 or 3 or more than that. Then the treasury stock. Treasury stock means it is the repurchase of existing shares from the market. So this is the final summary for today's discussion. So first one, what is dividend? What we discussed, what is dividend? Dividend represent the profit distribution to the shareholders. Then the dividend policy define payout strategy. Dividend policy is determining how much dividend has to pay as dividend and how much profit has to be retained in the business. Then what discussed about the stock dividend, stock split, increase shares but differ in accounting. Dividend changes may signal to the market. That means based on the dividend policy or dividend declaration, there will be some indication to investors or in the share market, so which will affect the value of the business or market value of the company in the future. Then the treasury stock reduce the outstanding shares. Treasury stock means it is the purchasing of existing share from the market by using its fund, its own retained earnings. So it will reduce the number of outstanding shares in the of a company. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.